Hello, welcome to a new video in days 116 sale and leaseback transactions. This is about latest changes in section of paragraph 102A. Now, recognition and measurement of sale and leaseback. The seller lessee shall measure the right of use asset from the leaseback at the proportion of the previous carrying amount of the asset that relates to the right of use retained by it, based on the amount of lease liability as a proportion of fair value of the asset. Now, at the commencement date, the seller lessee has two accounts. One is right of use asset and the other is lease liability. Lease liability can be ascertained from the present value of future lease payments. Now, what about right of use asset? You see, it is the proportion of the previous carrying amount of the asset that relates to the right of use retained by asset. That means the previous carrying amount of the asset has two parts. One part is right of use retained by the seller lessee, and the remaining part is right of use transferred. Now, this method does not specify, they don't prescribe what is the method for determining this procedure. One right of, one asset is there that is sold and leased back. It has two parts. One part is right of use retained and the other part is rights transferred. What we generally do, you see, it is given at the bottom, the italic. It should be based on the amount of lease liability as a proportion of fair value of the asset. For example, if the lease liability is 80% of the fair value of the asset, right of use asset retained should be 80% of the carrying amount of the asset. I repeat, if the lease liability is 80% of the fair value of the asset, right of use retained has to be 80% of the carrying amount of the assets. Let's take an example, things will be easier to understand. Now, consideration at fair value given 15,000 rupees, carrying amount of PPE which is sold and leased back, it was 10,000 rupees, annual lease payment 2772, incremental borrowing rate is 5%, life is 5 years, and depreciation is under straight line method. So the first thing is what? That is the cash receipt, which is the fair value of PP, 15,000 rupees. That is debit. Now, we derecognize PP, the carrying amount, because that has been sold. That is 10,000 rupees. Next is our lease liability, that is 12,000 rupees. How do you get 12,000 rupees? 2772 is the equal annual lease payment for 5 years and the discount rate is 5%. That comes to 12,000 rupees. That means the seller lessee determines lease payments to reflect equal periodic payments over the lease term when discounted using the incremental borrowing rate, that is 5%, that will result in the carrying amount of the lease liability at the commencement date of CU 12,000 rupees. Simple thing, present value of 2772 payable for 5 years, but the discount rate is 5%. It comes to 12,000. So 12,000 is the carrying amount of lease liability at the commencement date. Next, what is the proportion of lease liability of the fair value of PPE? Lease liability is 80% of fair value of PPE. That means right of use asset will be 80% of the carrying amount of PPE. You see, 8,000 is 80% of 10,000. How do we get 80% of 10,000? Now the balancing figure is the profit. That is gain on rights transferred 1,000 rupees. How do we get? You see 15,000 rupees cash is received from selling the asset and 12,000 is the lease liability created. So gain is 3,000 and 10,000 rupees is the carrying amount, out of which 8,000 is proportion retained. So proportion transferred is how much? 2000. So 3000 minus 2000, 1000. That is gain on rights transferred. Same example we continue. You see, same example, cash is 15, ROU asset 8000, PP 10,000, lease liability 12, gain is 10,000. Already discussed, retained 80% and transferred 20%. Now you see, how do you calculate gain on rights transfers? We calculate in a different way. Now you see, cash minus PP, that is the difference between the fair value PP and the carrying amount of PP. 15,000 minus 10,000. That is 5,000 total profit. Out of the 20% is transferred. So 20% of 5,000 is 1,000 rupees. That is gain on rights transfer. Now we calculate, you see, there is no gain or loss on right of use asset retained because one cannot do business with oneself. Here gain should be equal to the loss. What is the gain? That is 80% of PPE, that is difference between the fair value and the carrying amount. 15,000 minus 10,000 into 80%, that is 4,000 rupees. You go back, total profit is 5,000, 1,000 in regard to asset transfer. Balance 4,000, 5,000 minus 1,000 is retained. So 4,000 is the gain. What is the loss? Loss is lease liability minus right of use asset. 12,000 minus 8,000. As you know, the first entry is right of use asset debit to lease liability. So here difference of 4,000 rupees loss. So that loss of 4,000 is compensated by the gain. So there cannot be any gain or loss on right of use assets, but there is a gain on right transfer, that is 1,000 rupees. Next, the new thing, summary of para 102A, that is the newly added. After the commencement date, the seller lessee shall determine lease payments or revise lease payments in a way that the seller lessee would not recognize any amount of the gain or loss that relates to the right of use retained by the seller lessee. So what has happened at the commencement date? The same thing has to continue after the commencement date. The lessee shall determine lease payment in a way that there is no recognition of any gain or loss that relates to the right of use retained by the seller lessee. Next, applying this requirement in this paragraph does not prevent the seller lessee from recognizing in profit and loss any gain or loss relating to the partial or full termination of a lease. When there is a termination of a lease, partial or full, this this amendment does not apply. This paragraph does not prevent the seller lessee from recognizing in PL any gain or loss to the partial or full termination of the lease. Next, lease liability, opening balance ascertained, that is 12,000 rupees. Now, lease liability is increased by the interest charge, that is the time value of money you see first year, 5% interest charge on the opening balance, 12,000 rupees, and it is reduced by the lease payment made, 2772. That becomes the closing balance. So, this closing balance becomes the opening balance for the next year, and this is how the process is on. Every year, the interest is charged on the opening balance, and equal payment is made, 2772. That reduces the carrying amount of the lease liability, and the process is on until at the end of the 5 year, the lease liability is zero. Now, the important thing in this new amendment, what we need to see is that you see the seller lessee shall recognize in profit and loss the difference between the payments made for the lease and the lease payment that reduce the carrying amount of the lease. 2772 reduces the carrying amount of the lease. But if the payment is more than that, that is a separate thing. That will not reduce the carrying amount of the lease liability. For example, if seller lessee pays rupees 3,000 for the use of the asset in the first year, it recognizes you 228, 3,000 minus 2,772. That is 228. In the profit and loss as as variable lease payments, which is not included in the measurement of lease liability. I repeat, lease payment should reduce the lease liability. But any payment made above that, that should be taken as variable lease payment, which is not included in the measurement of the lease liability. Lastly, right of use asset, you see 12,000 rupees the opening balance, 5 years is the life. They follow straight line method. So every year they charge 20% of 12,000, that comes to 2,400. The process is on until 5th year, when the value of right of use asset becomes zero. Now, the last thing is application. The seller lessees have applied these amendments for annual reporting periods beginning on or after 1st April 2024, retrospectively in accordance with Ind AS 8 to sale and leaseback transactions entered into after the date of initial application. That means this amendment can be applied retrospectively. That means it will have an effect on equity. Thank you.